Hi, welcome back to the channel. Rico O'Mara of O'Mara Trading. I've got a new microphone. I hope it sounds a little bit better. I am trying still to master this video presence on YouTube. It's been hard because I'm not a natural talker. I don't know anything about filming or cameras or anything like that. So we're winging it. That's what we're doing. We're trying to get as much content out there as possible, and hopefully it gets better every time. So if anyone's got any advice, please let me know in the comments, and hopefully things do get better, you know. So right now we're in a very difficult time. It seems like we've been in a difficult time since last October. It's horrible. I've been in the markets for around 15 years, and I don't think I've ever experienced what we're going through now. The amount of volatility, the amount of sideways action, the geopolitical events. It just seems like the world is like coming to an end. But the markets always get through. The markets always find a base and move higher. You think that things are never going to get better, but these are the times when you really need to have an eye on the market. A lot of people say walk away and come back when it's all finished, but I've been there many times, especially through COVID, when the world looked like it was coming to an end, and I just thought, sell everything, just walk away, and once the dust settles, I'll come back and get involved in the market. Once that dust had settled and I came back to the markets, I found the markets pretty much back at all-time highs, and I'd missed some massive moves. And I think that's what's going to happen now. It always happens through war. I think the market's going to give us lots of volatility over the next week or two. It's going to shake a lot of people out, and then it's going to drift up higher. And we're going to see all-time highs in the next couple of weeks, because it always happens. I am sitting here watching the markets every day, trying to resist pushing those buy and sell buttons for now. Just monitoring the situation. I'm looking at the headlines that are coming out, even if it's Sky News or BBC. I'm looking how far down the list the talk of war goes, because it does. Other things come in and dominate the news because people get bored very easily. When people start getting bored of the headlines, that's when the market starts drifting back up and finding a bit of a trend. So today we're going to talk about swing trading in difficult conditions. Geopolitical tensions in Iran, the trade war noise, inflation fears creeping back in, software stocks getting absolutely battered. Some names are down 30, 40, 50% from their all-time highs. And if you're sitting there staring at your screen thinking, what the hell am I going to do? I get it. But here's the thing. Markets have always bounced back, as I've just said. In 2008, the financial crisis, I remember thinking it was never going to end. The world looked like capitalism had finished. And then, as we just mentioned, there was the global pandemic. All economies shut down overnight. But then the market went up higher. Every single time. So I'm not losing my cool right now. If you're swing trading like me, you shouldn't be either. Fear creates opportunity. While everyone else is running for the exits, that's when we're building watch lists. That's when we're doing research. That's when we're getting ready for the next move. Now, I want to be straight with you. I do research today that I think could be worthless tomorrow because things are changing so fast. A single headline or a single tweet or truth and the whole thesis shifts overnight. That's the game we're in. But that doesn't mean you need to stop working. You keep doing the research. You stay ready. Because when these entries come, and they will come, you already want to know the story. So today I've got two names for you. They're not exciting names. Again, as we've talked about on this channel before, I am not promoting the Mag 7. I am looking for trends in other areas of the market. Areas of the market that are going to actually make us money. But they don't sell very well on YouTube. These two companies are very different setups. They're both sitting on my watch list right now. I've looked into them a little bit in depth this week. So first one, Servicenow, ticker Now. It's in the software sector. Not the most exciting name in the world. You won't see this stock advertised on the telly. But strip it back, and what you've got is software that sits underneath some of the world's largest organisations. IT requests, HR processes, customer service, compliance. When a massive company needs thousands of moving parts talking to each other across different departments, Servicenow is usually the thing that's making that happen. And once a company starts using it, they almost never rip it out. That's stickiness in the moat. And at the moment, we can see software is waking up. Software stocks have had a terrible few months. People are calling it the SaaS-apocalypse. The idea that AI is going to take over and make most of the software companies irrelevant. And look, there is something to that narrative, but here's what I know from watching the markets. The best opportunities sit right in the middle of maximum fear. And a few things have shifted recently. Rate cut expectations are back on the table, or the war, before this all kicked off, which is why I mentioned about my research coming a little bit messy straight after I've done it. Software valuations re-rate fast when things change. Enterprise IT budgets are reopening. After 2 years of CFOs, company financial officers, cutting every subscription they could find, the spending is coming back. Jensen Huang went on CNBC and basically said the market has got this completely wrong. AI isn't killing enterprise software. It's supercharging it. And again, with what's going on at the moment in Iran, cybersecurity, enterprise software is getting a serious bid. Governments and corporations suddenly very aware of how exposed they are to state-sponsored cyber attacks. Real money is flowing into this sector once again. So what about the valuation? Here's a bit that surprised me. Servicenow historically trades at around 72 times forward earnings. That's the long run average. At its peak, over 100 times. But right now, it is trading at 27 times forward earnings. That is the lowest the company has ever traded at, sitting right at its all-time valuation floor. And the business hasn't deteriorated. Revenue growing at 20% a year. Constantly for years. Free cash flow margins approaching 35%. The fundamentals are actually stronger now than when it was trading at 100 times. What does a re-rate back to normal times look like? At 40 times, roughly half the historical average, you're looking at around $166. At 50 times, still well below average, you're looking at around $208. Servicenow CEO Bill McDermott goes into the open market, buys 28,682 shares at around $105 each. That is roughly $3 million of his own money that is put into his company. Not stock options, not a bonus, his own cash at the lows in the open market. But that's not even the most interesting part. At the same time, he and several other senior executives have cancelled their pre-planned stock sale programs. They have cancelled selling. These are the people who know their company more than anyone else. And they've looked at it right now and they've decided it is way too cheap to sell. This stock right now is trading at $120. So what about the chart? Well, the fundamentals tell you what to buy. The chart tells you when to buy. Servicenow has had a savage drawdown, just like most of the other software stocks, down at around 50% from its highs. It found a floor at around $98 to the $100 level, and it started to push back up. The 9 EMA, which I like to use, is crossing over the 20. Volume picking up on the green days. Buyers are showing up with conviction. It's still well below its 200-day moving average, but there's plenty of room to recover before it gets technically expensive. As always, there's risks, and we look at the risks. The elephant in the room is Microsoft. It is bundling AI into its Microsoft 365, the thing that most enterprises are already paying for. If that's good enough for most companies, it could eat into Servicenow's AI products. And then there's also 2 active DOJ investigations. Details on this are quite limited, but that kind of thing keeps a lid on valuations. So this is a volatile stock because of everything that's going on. 13 moves of 5% or more have been in the last year. So if you're getting involved, we need to size accordingly. I wouldn't say right now this is a deal breaker for me. I'm not itching to push the buy button, but I'm watching. My take on this is it is a world-class business. Cheapest valuation it's ever traded at. Sector starting to rotate back into favour. The boss, the CEO, has got $3 million of personal skin in the game. I'm not chasing the recent spike, but if it pulls back and maybe it consolidates, I might look at a potential trade. That's where I'm looking for my entry. If it doesn't, I'll move on. That's discipline. That's not chasing. That's what keeps me in the game. Also, looking around the markets this week, my eyes got turned to another company. Another company just like Servicenow that not many people talk about. It's Virtiv Holdings, ticker VRT. Data center infrastructure. The picks and the shovels. So what do they do? The name doesn't help. Sounds like a bit of a holding company for something incredibly dull. But let's strip it back. This business makes a physical infrastructure that keeps data centers alive. Power management systems, cooling solutions, the racks, the bus bars, the thermal chains, all the unglamorous stuff that has to work perfectly 24 hours a day, or the whole thing falls apart. Every time Microsoft, Google, Amazon announces a new data center, Virtiv are involved. Someone has to fill it with kit. And Virtiv is one of those companies that are doing this. This is what people mean by the picks and the shovels. You're not betting on which AI model wins. You're betting on the infrastructure. Well, what about the numbers? Well, let me give you some numbers from Q4 earnings because they were, I think, generally jaw-dropping. Q4 orders were up 252% year on year. Their backlog now sits at $15 billion, more than double it was a year ago. Full year 2025 revenue was up $10.2 billion, 26% organic growth. And for 2026, I think they're guiding at around $13.5 billion in revenue. EPS of $6.02, a 43% jump. But here's the thing that stood out the most to me. After orders more than doubled. Virtiv isn't just selling the same old data center kit. The whole industry is going through a technology shift. And Virtiv is right at the center of it. Liquid cooling is the future. Traditional air just can't handle the heat and density of modern AI chips. Virtiv is one of the leaders here, with years of real-world deployment experience that new entrants simply don't have. Power architecture is evolving. They are co-developing roadmaps with the chip makers 2 to 3 years out. Not scrambling to catch up. They're already there. And services? Nearly 5,000 field engineers globally. Service revenue is growing over 25% year on year. The more kit that they install, the bigger the base they service. So what about the valuation? Is it overvalued? Well, let's be honest about it. The current PE of around 73 times, that's the thing that makes value investors choke. Using a fair average PE of around 25, reasonable for a quality industrial name, applied to a 3-year average forward EPS estimate. This is the way I do things. It might not be for you. It's not for an investor, but it's good for a swing trader, just to get an idea. I get a fair value of around $198 a share. Today's price, $251. That's roughly a 27% above fair value for my numbers. And you can't really wave that away, can you? But as swing traders assessing our risk on every trade, sometimes these overvalues can fuel a trend. Buy high, sell higher. But prepare to flee quick if everything goes wrong. So what about the bull argument? Virtiv sits at the intersection of AI, data centers, liquid cooling and power infrastructure. all accelerating at the same time. The market isn't paying a premium for that. But here's where I have to be straight with you. At $251, you are paying for everything to be perfect, everything to go right. No margin misses, no macro shock, no slowdown in AI spending. Even the institutional investors at Barclays conference recently put out a warranted PE somewhere in the region of about 20. So the smart money thinks it's stretched as well. My conclusion, don't argue against it. Accept it honestly. The stock is pricing in a future where earnings grow into the price. If that happens, people will look back at $251 and think it was way too cheap. And if it doesn't, there will be a meaningful downside. That's a bet that's on the table.